So maybe you're like me and you took advantage of the low interest rates in 2020 and 2021 and you refinanced at that time to get a rate in the 2s, 3s, or maybe even the 4s. And since then, your home's value has gone way up in value and you got all this equity sitting there that you would like to get some access to, but you don't want to touch your mortgage because you got a great rate on that mortgage. So what do you do? How do you access the equity in your home? Well, that's the topic of today. We're going to do a deep dive into some home equity solutions, the pros and cons, and whether it's the right option for you. My name is John Ritter with Ritter Mortgage Group, and we help homeowners finance the purchase of their dream home, refinance, do home equity solutions. Whether you're thinking about moving in 9 days or 90 days, give us a call, shoot us a text, send us an email. We love helping folks just like you with accessing financing for their home. Now, let's take a deep dive into home equity. Now, the first thing that we got to establish here is what is home equity? In other words, what is that? Some people don't understand the term. What does equity mean? Well, equity is the portion of your home that you actually own. So let's say, for example, that your home's value is $400,000 and you owe, let's say it's $300,000. This is what you owe, and this is what it's worth. So the difference right here, that $100,000, that equals your equity. So this is the amount of the home that you own. So if you were to sell your house, that's the amount of money that would come back to you as your profit that you could take with you when you move on. But if you want to stay in your home, how do you get access to this money while you're there and you want to use it? Because your equity is a great tool to leverage for whether you're doing home improvement projects, sending a kid to college, or consolidating high interest rate credit cards, whatever the reason might be. How can we access this money? Well, home equity comes in two different shapes and sizes. You have what's called your home equity loan and you have your home equity lines of credit. And let's start with the home equity loans first. Your home equity loan is an amortized loan, which means when you make your payment, you are paying principal and interest from day one to the end of the loan, and you're working towards paying that loan off as you go through it. It's also a closed-end loan. What we mean by that is you can only use it one time. So once you borrow the money, once you pay it back, that's it. The bank's done, you're done, there's no more loan to be had. It's also a fixed rate product, so your interest rate will stay the same. Just like if you have a 30-year fixed mortgage on your primary mortgage, on a home equity loan, the rate is the same from beginning to end. There are no changes. So it allows you to budget better. It allows you to, determine how much money to set aside every month to make sure you pay that bill. Now, what's nice about home equity loans is they do come in different shapes and sizes as far as how long you want to borrow the money. You can do it for 5 years, 10 years, 15 years, 20 years. There are some places that do 30 years, but it's not quite as common. Now, the thing you should know about that is the further you go out, the higher your interest rate will be. So the longer the bank has to guarantee you that rate, in spite of what's happening in the market at present day, that's risky for them. So they're going to tweak the interest rate to offset that risk. So that's a home equity line of credit, or I'm sorry, home equity loan. If we go over to the home equity line of credit, there's a little bit of things that are different. First of all, when you make your payment on a home equity line of credit, it is interest only during your draw period, and we'll get to the draw period in just a second, but home equity line of credit functions very similar to a credit card. You know, when you get your credit card statement, you have your minimum payment, and a lot of times your minimum payment is not even the amount that you charged in the past billing cycle. So if you make just the minimum payment, you're not making a lot of headway on your balance. Well, the same is true with the home equity line of credit. Your minimum payment is the interest that accrued in the last billing cycle. So if you just pay the interest only, then your balance is not going down. Now that's available to you during the draw period. And let's talk about that for just a second. So your line of credit is going to be broken up into two parts. The first part is your draw period. This is when your money is revolving. So that gives us to the second point. The line of credit you're able to use again and again, just like your credit card. You know, when you get your credit card, you don't just have access to it one time. you can use it again and again, assuming you're paying the balance down, and any free amount of your limit you're available to use again. That's the same on a line of credit. As you charge or use it and you pay the money back, that money that you paid back is now available to use again during your draw period. Typically, your draw period is either going to be 10 or 15 years. There are some variations, but normally you see 10 or 15 years. So during that draw period, the money is revolving, your access is revolving, you only have to pay interest only. And then at the end of your draw period, they freeze whatever your balance is at that time. And from that point forward, you can no longer take any more advances, and you're now paying principal and interest, so that the second half of your home equity line of credit period is what we call your repayment period. So the goal there is by the time you end that period, you have paid the loan back. So a 10, which is a 10-year revolving 10-year repayment, or a 15-15, which is a 15-year revolving 15-year repayment, and then by the end of it, it's all done. Now, the other major difference with the home equity line of credit is that it is a variable interest rate. Anytime that you hear the Fed changed rates, what they're changing is called the Fed funds overnight rate, which is the rate that they charge banks to come borrow money from them. That has a direct correlation to what's called the prime rate. And that's what equity lines of credit are based on, prime rate. So whenever they change the Fed funds rate up or down, that's impacting the prime rate up or down. So depending on where we are in our economic cycle, the Fed may have raised rates, they may have lowered rates, but if you're not a fan of not knowing what your payment is going to be, if you're on a very strict budget, then maybe this option isn't for you. But it's a variable interest rate, which means variable payments. And then at the end here, again, it's a 10-10 or 15-15. There are some other variations out there, but normally what you see is something along these lines. So again, we have the home equity loan and we have the home equity line of credit. Sometimes you'll see that referred to as LOC, line of credit, but both of those will give you access to the equity in your home. Now, if we're going to compare them side by side, again, the home equity loan is a fixed rate. The home equity line of credit, or HELOC, is not. It's a variable. The home equity loan you cannot use multiple times, whereas the home equity line of credit, you can use that over and over again. So some people like that. If you have like home improvement projects, like if you want to put on a deck, you access your line of credit, put the deck on, you pay that back over a couple of years, and then you have a new project. Maybe you want to remodel the bathroom. Well, you don't have to borrow money again. You already have the line of credit sitting there, and you can access it, as you need to. And then the last thing I wanted to point out here is a home equity loan typically will not go as high up in equity as a line of credit will. So let me explain what I mean by that. A home equity loan will maybe go to 90% of what your home is worth. So if your home is worth $100,000, they're only going to go to $90,000. Whereas a line of credit, it is possible to find banks that will go to 100% of what your home's value is. So if the amount of the money that you need is important, there's a good chance you could get access to more of it with a line of credit as opposed to a home equity loan. So there you have it, a brief rundown on your home equity solutions. If you still have more questions, or you want to know how a personal home equity loan, home equity line of credit would apply to you, reach out. We'll be happy to help you evaluate what your options are, or maybe even if a cash out refinance might be a better solution. So all of the contact information is down below. Thanks for watching.